to this joint e-MFP and FIF UK webinar entitled, Are We Managing? A cross-sector panel discussion on COVID responses. My name's Sam Mendelsohn. I'm Financial Inclusion Specialist at e-MFP and Board Director at FIF UK, and I'm going to be moderating this session. Briefly, a bit about e-MFP and FIF to kick us off for those who don't know either of us well. e-MFP is the leading network of European organizations and individuals active in the financial inclusion sector in developing countries. It has over 130 members from all geographic regions and specializations and various work streams on research, supporting year-round action groups, coordinating the annual Microfinance Award, and organizing the annual European Microfinance Week. FIF UK began in 2005 as the UK Microfinance Club, and it's a UK-based network raising awareness of inclusion and sharing best practice. FIF holds a number of evening events in London on themes like digital finance, fintech, consumer protection, smallholder agriculture, and several others, as well as a quarterly breakfast event called the Financial Inclusion News Review, which is an interactive roundtable to debate and share insights on recent developments in financial inclusion. So a quick background on today's session, I'll be as short as I can. For the last several years, e-MFP and FIF have collaborated on an annual event held in London. This presents the takeaways from the previous year's European Microfinance Award and the publication called the European Dialogue, which distills those lessons and case studies. It became clear some time ago that an in-person event would not be feasible. This probably sounds familiar to you all, and that the urgent should take priority over the important. So that event on strengthening resilience to climate change will be pushed back to a date in June or July to be confirmed. Instead, we decided to leverage the key value and advantage that both these organizations have, our relationships and networks with key stakeholders and our friends, opinion leaders and decision makers, to put together a panel on cross-sector COVID responses. We've all been inundated in recent weeks with webinars, briefing papers, newsletters. e-MFP itself has been heavily focused on this topic, including setting up, with support from SPTF and CFI, the new COVID for Inclusion blog, essay and discussion forum that some of you may have seen. But what we've taken from conversations with our members over the last weeks, and the same is true for FIF, is an interest in a session that takes a pause for a moment, several weeks into this ever-changing and confusing and complex crisis, and asks, looking at the issues affecting clients, groups, providers, investors, support organizations, and others, where are we now? Are we on top of things? Where are we failing? Where are we coping or succeeding? In short, are we managing? To this end, we're very grateful for today's stellar panel to come and talk to us about these issues and take your questions. Before that, a couple of minutes on housekeeping. Everyone who is an attendee is automatically muted. We're not going to use speakers' videos in order to preserve bandwidth. You will see, if you're not that familiar with Zoom, a Q&A tab on your screen. This is a great opportunity to have your questions put to speakers, and we're going to have plenty of time for that. Please keep them in question format if you can, and if possible, identify who you'd like the question to go to. After the speakers' initial presentations, my colleagues and I will be going through them, and we're going to put some of these questions to the speakers. If you really want to ask the question yourself or to make a particular comment on audio, please raise your hand and we'll try to get to you, unmute you, and so you can ask it. The running order today is that each of our 6 speakers are going to talk for about 5 to 7 minutes, and as part of long-standing FIF and e-MFP policy, and a recent webinar we're aware of that went 90 minutes late and meant that almost everyone missed hearing all the ideas, I'm going to interrupt if necessary to keep things on track and make sure we have plenty of time for Q&A. This webinar will be recorded and available on both the websites. There's no need for me to go into the perfect storm of the public health crisis, the economic and financial crisis we're seeing with its different commonalities with certain previous crises. But here are a few questions to think about while you listen to the speakers. What can providers and other FSPs do to mitigate the cost to clients and protect themselves? What can investors do, individually and together, to balance their fiduciary obligations with their social mission, not to mention their interest in keeping their investees above water? What's the role for DFIs? When must or can regulators and policymakers intervene? None of these are revolutionary questions. They're everywhere right now, but they're just some things to keep in mind as you hear from the speakers. So I'm now going to welcome our first speaker, Mr. Rolando Victoria. He's founding ED of ASKI in the Philippines and now the president and CEO of the ASKI group of companies. He's going to give the first practitioner perspective, what's going on in the ground in the Philippines, what is the effect on clients, and how are ASKI and the government there responding. So I'm going to mute myself. Rolando, if you'd unmute yourself, and I'll control the slides. Thanks.
Okay, thank you very much. Good evening. I'm Rolando Victoria. As mentioned, I'm the founding executive director of Alalay sa Kaunlaran, the microfinance institutions more than 33 years now. So next background, please. A brief background of ASKI. It was established after the EDSA revolution as a non-stock non-profit organization, but the license was released only in 1987. And from microfinance institution, it grows to 12 different companies supporting one another to comply with regulation. Next slide, please. So where are we right now? We're operating in Luzon. As you all know, this is the lockdown ordered by the government, the whole of Luzon. We operate in 98 offices, supposed to be. We're about to open 2 more offices. However, due to lockdown, we have to delay the opening. We operate in Central Luzon, Western, Eastern, and Northern Luzon in 16 provinces and 3,264 villages in 256 towns. Next, please. So what's the situation in the Philippines? In the early months of 2020, that was January and February, we don't talk about much about COVID-19. It's all normal to us. However, on the second week of March, the president declared that the whole of Luzon will be under entire lockdown. They call it Enhanced Community Quarantine or ECQ. So the lockdown will last until May 15, 2020. That was declaration. And then he asked the Congress for an emergency power. And on March 23, Republic Act 11469 or the Bayanihan to Heal as One Act. Bayanihan is supporting one another. So it provides around 200 billion funds, emergency fund for the president to use in the rehabilitation as we support a lot of people. During enhanced community, there's a chaotic situation. People are complaining where to get the food. There's asking for money, the conditional cash transfer. So since businesses are closed, nobody would like to see that kind of scenario. Old people, young people, and then several checkpoints was established. And then a lot of people experience the shortage of health facilities and even personal protective equipment. There was a slowdown in food delivery because of a lot of checkpoints along the way, and then a lot of requirements for food delivery, especially the agricultural products coming from the different provinces. And young people and even older people are restricted to go out of their houses. Mass gatherings and even religious activities were not allowed. And then there is now a discussion on proposed Philippine Economic Recovery Act now being discussed in Congress, so that after this, they call it a stimulus fund to support micro, small, and medium enterprises. Next, please. Just April, there was an expansion of quarantine facilities, and they're conducting mass testing because thousands of overseas Filipinos are now coming home, and they are also required to be under quarantine for 14 days, and then mass testing will be conducted to them. They're now in different hotels and other quarantine facilities. The government now provides food pass so that the agricultural products can move, and then small businesses now receive social amelioration for small workers because it's no work, no pay now, but it's not 100% support for small businesses. And there were in some areas, 50% of the workforce based on selected industries are allowed to work. And there's also an imposition of loan moratorium without any penalties, interest. Also, there are no penalties. It's also among rentals was also, there were some extension also. The local government has to do their part also in supporting food distribution and cash distribution. The government is initiating, there's a lot of discussion on how government owned and controlled corporations, particularly the government banks, on provision of rescue plan for other businesses. They call it iRescue, for support the agriculture, and also for the educational sector on study now, pay later. And also, it's a wake-up call for the government now to really implement the national ID system. This is the major concern, because when the government distributes cash to the people, before it's being done, there's a house-to-house interview, and then it took time. And when the money is being distributed, it's also a manual distribution. Actually, until now, money is being distributed. Not all people who were issued the amelioration fund have received the money. So they said the absence of the national ID contributes to this problem, because it's so hard to identify who are the people that really needs the support, and also this overcrowding of people in Metro Manila. Next, please. On the part of ASKI as a microfinance institution, we immediately activated the disaster risk reduction team of ASKI. So we maintain the contacts with the clients through SMS, call them, because part of our strategy even before is to get in advance all their phone numbers, and then connect all people, all our members with micro insurance. We were able to pay 27 beneficiaries already. We have around 700,000 people under micro insurance program of ASKI. And for the last 2 months, 27 members died. And then we also granted loan moratorium to all the clients until lockdown. So we are also participating in the payment, because some of the beneficiaries of the government under conditional cash transfer, they have their own bank account, and through our initiative, we were able to support the distribution of cash using the POS. And for the employees, we provide advances. We are giving salaries while on lockdown. We also supported the initiative of local government in areas where we have branches in the relief operation, and also in providing some food packs. We are also part of a national network, the Microfinance Council of the Philippines, and the Alliance of Philippine Partners in Enterprise Development, and the Microinsurance Network. We are having a 3 times a week meeting on assessing what's happening. We are doing a lot of advocacy on the government side. Next, please. The challenges, it's not only the challenges for ASKI. this is the challenges that I'll be presenting is part of the discussion within the Philippine network in the Philippines. That's the number one challenge is liquidity, because is the partial lifting of lockdown was made only last Monday, and not all microfinance operations are open, especially in areas where there are high incidence of COVID-19. So we're saying that as an industry, even in terms of ASKI, if we will not be allowed to operate it this May, majority of microfinance will suffer liquidity problem by August. So part of as a network, we are doing a lot of advocacy on restructuring of loans with major creditors, because all of us are relying mostly on financial institutions, usually government banks. And it's only now that we realize that there's really a need for the full implementation of digitization of the transaction. Actually, before the issuance of lockdown, we were conducting, ASKI is already conducting a series of training for the clients on the development of digitized transaction, loan disbursement, loan payments, and savings, and even insurance payments. However, we have to stop it due to lockdown order by the government. Even the national government is pushing for digital transaction. We do hope that now it's an eye-opener that the government will be aggressive on digital transaction. And there's really a need to review all the loan products so that it will fit to the need. And because as we can see now, there should be a new norm. And we have to be very strong in our advocacy when you talk about the new proposed law. It calls for 350 to 370 billion resources. And we hope that as a network, that will be our priority, since we are very active in all network in local and international. Thank you.
Thank you very much, Rolando. Now going to hand over the baton to Johanna Ryan. She is Global Director of Impact at VisionFund International, an umbrella support body for MFIs with a portfolio of almost $500 million and over 1 million clients. She's also, along with me, a board director of FIF UK. Johanna, how is the pandemic affecting those clients and those MFIs you work with and VFI itself?
Well, Sam, I guess we're managing. We are managing. But I'm going to start with the bad news, though I hope to leave you, after my short presentation, with a sense of optimism, not just for microfinance institutions, but also for the communities and indeed the clients that we serve. VisionFund International is part of the World Vision Partnership, and like our parent charity, we work towards our vision that children should have life in all its fullness. VisionFund International is in most cases the owner-operator of the microfinance institutions in 28 countries, serving more than 1 million clients who themselves are caring for more than 3.5 million children. We work with vulnerable families, which in economic terms means that they live at or below their local national poverty line, and more than 60% are in rural areas of lesser developed countries. COVID-19 has affected operations in all those countries. There has been a total lockdown in most countries in Asia, Latin America, and in the Balkans and Caucasus where we work. In Africa, which represents nearly half our client numbers, there has been partial lockdown in 9 countries where we work, though pretty much total lockdown for our operations in Uganda and Rwanda. Next slide, please. So lockdown and social distancing mean, first of all, that our field staff cannot interact in person with clients, and that borrowing and savings groups cannot meet. In terms of farming, services, and indeed all livelihoods, trading has been dramatically curtailed. In fact, just earlier this morning, I received the analysis of a survey of 1,800 clients across our MFIs in Africa. 91% report reduced incomes due to COVID-19 related restrictions. So, as Rolando has just indicated, the first impact on VisionFund is on our liquidity. As of last Friday, 15 countries where we work have repayment moratoria in place. 21 institutions are able to collect less than 30% of budgeted repayments. 23 institutions are able to disperse less than 30% of budgeted new loans. This is a crisis that requires us to respond both locally and globally. Next slide, please. In December, before COVID-19 hit our operations, VisionFund's global portfolio risk figure was 3.7%, and our loan loss ratio was 2.8% for a total of 6.5%. We are now forecasting that that combined figure will increase to something between 9 and 15% by the end of September 2020. This is important in two ways. The value of that measure, the portfolio at risk and loan loss ratio, has financial implications for the institution. While the number of those loans that are at risk or written off represents the numbers of families who are in distress. Our regulated MFIs, especially those that mobilize savings, have to meet minimum capital adequacy requirements, and any erosion of their capital may require cash injection from VisionFund as the parent. And more generally across our MFIs, as a result of deteriorating financial performance, the MFIs could breach loan covenants, which would require waivers from the lenders. In other words, we're all in this together. The lenders and investors in a single country MFI, the MFIs themselves, the MFI's parent, which in this case is VisionFund, and the lenders to VisionFund globally. The reason that all of us are on this call today, those of us who work in microfinance, is because we all know that we can help to make communities and families more resilient, and that we can contribute to Sustainable Development Goal 1, eradicate poverty. Next slide, please. So what is VisionFund actually doing about this? Well, first of all, disbursements are way down in order to protect our cash reserves, but of course the demand for credit is down anyway. We are driving a major acceleration of digital payment solutions, especially in Latin America and Asia. Our MFIs in Africa have mobile money applications already widespread in their operations. And aligned to this, we're renewing loans to existing clients with no need for a wet signature. We are, of course, doing intensive fundraising, often with partners who specialize in WASH programming. And this is really important to say. Our constituency are vulnerable, and they are likely to suffer not just one shock of losing their livelihood, but other shocks, such as health emergencies, and in East Africa, we're already dealing with the impact of locust invasions. And meanwhile, indeed, as we've already heard, we've got to be planning for the new normal. This means identifying various possible future scenarios, understanding the triggers, and identifying the relevant responses in each case. Next slide, please. But first of all, our response must be focused on protection. Some of our clients actually are adapting their own businesses to supply soap and PPE to their communities. Our field staff are now working in virtual call centers, maintaining relationships and understanding feedback from clients so that we can adjust our services and products. We are reviewing all our clients' situations individually, rescheduling their loans where this makes sense, though not yet writing anything off. We've created an emergency loan for consumption for those clients who have the ability to repay once they recommence their livelihoods. But perhaps most importantly, we're preparing to provide disaster recovery loans to those businesses that will be able to restart if they receive a cash injection to do so as soon as the crisis starts to turn. VisionFund has used recovery loans in response to the El Niño effect in East Africa and after Typhoon Haiyan to the total value of $5.5 million. The default rate was just over 1% of that total, which indicates the efficacy of this intervention. You can see the other points on this slide and some points I skimmed over earlier, but I think I'll end on a high note. Clients will recover their businesses if and when VisionFund and all the other stakeholders in the chain of support work together to assist them with the cash they need when they need it. Thank you, Sam.
Thank you very much, Johanna. I'd now like to warmly welcome Fabian, who's Managing Director of Centenary Bank in Uganda, the country's leading commercial microfinance bank, serving more than 1.4 million consumers. And it has an especially strong savings focus, one of the other reasons we wanted to invite him to speak. And they employ over 2,600 staff. Fabian, can you tell us what the challenges Centenary Bank are that you're facing? What are the challenges your clients are up against, and the solutions that you're trying to implement?
Thank you very much. Thank you very much, everybody. Hi, and thank you for giving us an opportunity to share the challenges that we're undergoing. I've been listening to the presentation of the VisionFund, and of course, Uganda was mentioned as one of the countries where lockdown took effect, and it took effect on 21st of March to date. So nothing is happening. Movements are restricted of people. They've identified a few essential services to keep operating. Banking is one of them, but movement is restricted. They had to give a few passes to a few staff, meaning that we have 74 branches, but it so happened that because, in some places, markets are closed, so we had to close a few branches. But even the ones that remained operating, there's been quite a lot of challenges transporting people, rather staff, to be able to serve our clients in time. So what has happened is that we've changed the hours of service. We used to begin at 8, now we begin at 9 and close at 3. We used to close as late as 7 in the evening, but now we are closing early because people have to move, have to travel home. There is a curfew beginning at 7 o'clock in the evening, meaning that nobody is expected to be moving at that time. So there's been quite a lot of disruption to businesses of our customers. There has been a lot of disruption to collaborative offices. For example, courts are not as open as they used to. Registration services, business registration services. If we want to do recovery, for example, there are no courts to be able to assist with the recovery. So what we are going through is quite a challenging time. And of course, we've embarked on, first of all, educating our people on, first of all, the pandemic, and also educating them on how to protect themselves. But most importantly, because we are no longer in touch with our staff, we had to coin various ways of maintaining communication with them. So now it is, we are using a lot of social media, we are using a lot of online methods, Zoom, Team systems are the ones we are using to communicate with the over 2,700 staff that we have, but it is a big challenge. And also to maintain, their morale, to maintain their welfare, to ensure that they are all safe is quite a big challenge. Movement of clients is also limited, as I've mentioned, which has led to difficulties in monitoring loans. And advancing new loans is a problem. Previously, we used to disburse about 140 billion Uganda shillings. 140 billion is like, in US dollars, should be about 140, should be about 500,000 US dollars per month. No, 500 million per month as disbursements. But now we are disbursing less than a tenth. No. We did 27 in April, as opposed to the 140 billion that we've been doing, meaning that there is marked reduction in revenues. And also the quality of those loans. By the time we closed the March, portfolio at risk was at 4%, but by the time we closed April, it had jumped to almost 6% and still increasing. So we can no longer now open accounts freely like we used to. So onboarding of new clients became a big challenge. This has led to reduction in business and revenue to the bank, which has the potential of eating into the capital of the bank. Of course, as a regulated microfinance bank, there are minimum capital requirements, which the central bank hasn't adjusted as yet. There are also minimum liquidity requirements, which again, the central bank hasn't adjusted as yet, meaning that there's going to be quite a big challenge to be able to maintain the regulatory requirements as required by the regulatory authority. Move on. Can we move to the next slide, please?
I think we are on the next slide now.
Yeah, you did. Thank you very much. Restricted monitoring of loans, because our clients, our staff now can no longer move to the businesses of our customers. I've already talked about the loans getting bad. The other effect is that we've focused quite a lot on protective measures for both our customers and our staff. And, things like buying sanitizers, ensuring that there are facilities for washing of hands, their temperature monitors, whoever comes in, social distancing, whereby to date expenses have, in relation to this, to date we've counted about 1.5 billion Uganda shillings. 1.5 billion is like 500,000 US dollars already as expenses going towards meeting requirements as far as this pandemic is concerned. And of course, there is reduced demand for banking services, especially loans and deposits. Reduction in revenues, deterioration of loan quality, I've already talked about it, and which have the effect of affecting the liquidity and capital levels of the bank. Let's move on. Of course, our clients are challenged. They cannot freely move to access their banking services. And of course, a lot of their businesses are now shut. They are closed. The government has identified a few of them to open, but even those which open don't have the demand because people are not moving to go and buy whatever they are selling. We are now seeing more emphasis on agriculture, because that one was left open, and of course people have to eat. We are seeing more emphasis on delivery services, and things like a trade has been affected, tourism has been affected, manufacturing has been affected, which have been forming a big bulk of the businesses that we've been financing. So meaning that going forward as a bank, we need to again identify which businesses we need to move to or support as a way of continuing the growth of the business of the bank, but at the same time also supporting our clients. We've agreed as an institution, as an industry, that we need to protect three things. We need to protect our staff, we need to protect our clients, and of course we need to ensure that their businesses continue to operate, in whatever circumstances they find themselves into. And of course, those are not very easy things to manage. Let's move on. Necessary solutions given that situation. Of course, we are now in the process of identifying, possible solutions that we can effect. One of them is to ensure that staff continue to work, even if their movements are restricted. So we are having a number of them working from home. There are those who have gone on leave. There are those now we are struggling to ensure that they come to the offices every day to open, to be able to make our clients access services. We are now aggressively promoting electronic means of transaction, e.g. use of mobile banking. We've noticed that to date, we've seen a number of our clients, take up mobile banking. About a third of all the transactions that we are doing now are through mobile banking platform. About a quarter is of the transactions are going through agents. We have agent banking. So those agents in the rural areas who are distributed and are still open, we're having a quarter, although it has been sliding, going down because some of them are not able to open. We are seeing about 21% of the transactions going through our ATMs. We have the biggest ATM network, about 180 ATMs, and it is 21% of the transactions going through them. And it is only 20% of the transactions that are going through across the counter or in our banking halls. And of course, because people can't move. So, and that has prompted us to promote online banking, to promote the e-based mode of service. We are also, because of that increased use of transactions, all platforms, we know that we need to invest more in cyber security, because that comes along with the frauds, cyber security frauds or risks. And we are investing quite a lot now in that. We are also educating clients about the use of the technology to ensure that their transactions are safe and they minimize frauds as they use things like the mobile banking platforms. We are now also focused on reviewing methods of operations to ensure efficiency. Many processes we know are going to be reviewed. And as a team, we are focusing on discussing that to see what we need to change to be able to operate in the new normal. And that new normal, of course, we want also to look at the opportunities that will come with it, because we believe that should be able to give us opportunities of reaching out more to the clients, efficiently, but also making our clients be able to access our services, again, conveniently, without necessarily having to move to our banking halls. We are also looking at this as an opportunity to try to promote savings more, because most of the clients have realized the importance of having to put aside some money, not to consume everything every time they earn. And we are trying to promote this and also making sure that we design products that will enable people or clients to save in a convenient way. Things like onboarding clients online, opening accounts without necessarily coming to our banking halls are some of the things we are looking at as the things that will promote our operations and also support our clients even after COVID, when businesses have opened. So thank you very much. In brief, we have challenges, but we also want to look at the opportunities that have come with those challenges.
Thank you very much, Fabian. We had one hand raised from Alia in the audience. If possible, could you type your question? We'll try to take the written questions first. It'll be easier to organize them at the end. And then if there's time at the end, we'll come back to audio ones. But if you have a question for Fabian, please type it in there. And for everyone else as well, we encourage questions. We'll definitely have time for that. We're next going to hear from Babak Abbaszadeh, who's President and CEO of the Toronto Centre for Global Leadership in Financial Supervision. Babak's going to present his own slides on the evolving crisis environment, its effects on the sector, and what examples of supervision and regulatory responses matter most in this context. So I'm going to stop sharing my screen, and Babak, you can do yours.
Sure. Hi, Fabio. Thank you, everybody. And let me see. Are you able to? Sorry. Are you able to see my screen yet? Or? Yeah. Okay. Great. Well, first, everyone, can you hear me?
Yes.
Okay. Great. Thank you very much. First of all, I'd like to thank the organizers, Sam, and everyone for putting this together. We are a proud member of the microfinance platform. and the work that you're doing is critically important. Let me just give you a quick rundown.
Sorry to interrupt you, Babak. The share screen hasn't worked at the moment. Could you just try again?
Yeah, 1 second, please. I thought it was working. 1 second. Share screen. Okay. It should work now, right?
Yep, that's great. Thank you.
Thank you. Sorry about that. And thanks for allowing me to share the screen. I think it would be more efficient for me because I'm not necessarily going to go through all my slides. So thanks again for the organizers. This is very important. Just by way of a very brief background and introduction, we probably play a kind of a unique role in the microfinance platform in the sense that we are responsible for training financial sector supervisors and regulators. And since 1998, when we were established in the aftermath of the Asian financial crisis, we have trained more than 12,000 senior officials from 190 jurisdictions around the world. You see a sampling of the countries in which we have operated. Countries that are not represented are the ones who send their officials to be trained in one of these areas. And we train both in the area of financial stability, financial inclusion, all sectors of financial services, banking, insurance, pensions, capital markets, and of course, inclusive sector as well, and on market conduct and prudential matters as well. So moving on, I don't need to tell too much to this audience about the importance of the financial sector, but it's increasingly becoming more like a utility. It's kind of like an electricity. You notice it when it's not functioning, and it's so critical for everything that we do when it comes to financial protection and any of that matter. And the hallmark of it, a lot of it is the supervision and regulation to bring a degree of trust into the system. If the system is properly functioning, financial inclusion can thrive, and supervisors and regulators can play a critical role. But at the same time, sometimes it's also important for them just to get out of the way. So that's part of what we do in our capacity building programs for them. I was asked to talk a little bit about the crisis, and inevitably when you talk about this crisis, you reflect on the 2008 financial crisis. Very different. That was a massive localized recessions in 2008 in Europe, United States primarily. Today we are experiencing pretty much something close to a global depression. And at no time in our lifetimes or history books that we've read, the economic crisis came to a sudden, shocking stop at a drop of a hat. That's what happened this time. And it's really important to understand that and the implications that that has on everybody, not just the microfinance sector, but the real economy and everyone else. The breadth, depth, and uncertainty is huge. As public health officials always try to remind us in various countries, we're on virus time. The manifestations may be different, but basically there's been disruption of supply chains, shutdown of non-essential businesses, unprecedented spikes in unemployment rates that are taking us again to the Great Depression levels almost, and the long-term negative impact on the real economy, potentially leading to downward spirals. This is an important point because even if the crisis ends, it doesn't necessarily go back to the way it was with an elastic snapback. Businesses are going to get shut down. The suffering is going to continue. So, this is not something that is light for anyone, and we're all experiencing it in one way or another. The other key difference, the other key interesting point is that this time the banks are not the culprits. Most of you remember in 2008 and other financial crises that people experienced, sometimes financial institutions have taken enormous risks. A lot of times was to bring the bad boys and girls back in line. This time there are collateral damage, but they're very much part of the solution. They have to be part of the solution. They need to be brought into that. They play important intermediary roles. But I'm talking about banks here. That's just a euphemism for every key actor in the financial sector that you trust your money to, borrow money from. So at this point, I'm not really distinguishing much about the various players. Supervisors and regulators are also highly affected. They have a very tough job to play, which is to maintain financial stability in these times of uncertainty and high volatility. They need to respond to extraordinary situations without necessarily clear, globally coordinated policy responses, Coordination has improved quite a bit, but in the beginning, everybody was in a state of shock, as you can appreciate. Supervisors themselves are activating their business continuity and crisis management plans as they are demanding the banks and financial institutions to do the same. Also in tandem with their other brothers in the financial regulatory oversight, such as the ministries of finance, treasuries, and central banks, who are providing more liquidity and debt purchases and others, supervisors are also displaying a degree of regulatory forbearance, so tolerance. They're reducing some of their regular inspections, some of the demands that they have to try to address diminished liquidity, impaired credit quality, heightened operational risks, potential market misconduct. Of course, they have to have vigilance on these. They can't completely let it go. The implications are for you and I to be able to have some sort of an income in the industries that are open and be able to pay mortgages and et cetera, et cetera. On the microfinance sector, I can only highlight what one of our partners, CGAP, said, which was, if the microfinance sector is going to survive the pandemic, we need to treat COVID-19 as a fundamental threat to the industry that it likely is, risks to billions of people who are relying on the system to be able to borrow, save, and send money. So this audience would know a lot about the shock. I know the microfinance platform and their partners have written a lot of interesting blogs, and other organizations have talked about coordination. But also, as one of the earlier speakers said, it's not all dark and gloomy as it is. There's also opportunities here. COVID-19, think about it, has amplified opportunities for the urgency of utilizing fintech to keep financial systems functioning. There's an opportunity here to accelerate digitization because cash really truly is dirty and is a contaminant, and people don't have access to other systems of finances. I have experiences from our regulatory authorities in Peru and elsewhere telling me it's a big public health threat for people standing up in line at the ATM machines trying to take cash. So that's just one very simple example we can all identify with. Again, with every opportunity comes a risk. Risks have also amplified. So consumer investment protection issues are very much there. Potential threats to financial integrity, such as money laundering, terrorism financing, cyber fraud, and other illicit activities are very much there. So it's a very difficult thing to balance for regulators and supervisors. So obviously we are biased about this point, but supervision does matter. For this audience, financial inclusion is probably sacrosanct and everything, but we look at it as two sides of a coin, financial inclusion and financial stability. And IMF research has indicated the risk to financial stability increase when access to credit is expanded without proper regulation and supervision. That's a critical point. Therefore, investing in high quality supervision can pay big dividends as financial inclusion expands, and countries that have a low rate of financial inclusion also have big supervisory challenges. So that's how all of this dovetails into the mission of of Toronto Center for Global Leadership in Financial Supervision. And I think the challenge before all of us is to make sure that we don't lose the gains achieved in financial inclusion. So thanks again for the opportunity. I think I'm going to hand back the presentation to Sam. So thank you again, and happy to answer any questions at any point.
Thank you very much, Babak. Continuing to move up the chain from the client and the provider to the support system of the financial inclusion ecosystem, we're now going to turn to hear from an investor, Noémie Renier. She's head of debt for financial institutions at Incofin, one of the leading social investors in the sector. And she's going to talk about what Incofin and the other investors are doing to respond individually and collectively, and what the key challenges ahead are. So go ahead, Noémie.
Thank you, Sam. Good afternoon, everyone. Good morning. So Thanks for the introduction. Indeed, Incofin is a leading international impact fund manager focusing on investing in financial services, but also agro-food in emerging markets. We have been able to grow our total asset under management to 1 billion euro. These include today approximately 700 million euro of debt portfolio with financial institution and approximately 150 financial service provider, financial institution, microfinance institution. Our investor base typically include DFIs, pension fund, insurance companies, fund of funds, financial institution, high net worth, but also retail individuals. But that's enough on Incofin. Can move to the heart of the debate. What has been our response to the pandemic? The coronavirus is often qualified as a black swan of 2020. None of us really could see it coming, and we weren't prepared to see the world entering into a global lockdown. So we have been all professionally and personally impacted by the virus. And with health at risk, the priority was really to move from a business as usual towards crisis management, like any institution around the world. We have adjusted our strategy on operation, and as travel restrictions were imposed progressively around the world, we were also making sure that all our traveling staff could safely return to their home. That was the first step. Immediately, our investment managers also engaged communication with all our clients, trying to collect intelligence, field feedback to allow us to assess the situation. Gathering also all this best practice, we put together guidance from our investees around the world to face the COVID crisis. This covered very broad topics such as staff health, business continuity, key liquidity management tips, also how to communicate with the lenders. Obvious example that seems obvious today maybe wasn't on the 20th of March is advising our institution to reduce or cancel transaction fee out of branch operation. So we gathered all these best practice and we share, and this was an initiative that was very much appreciated by our investee. We also rapidly conduct a survey amongst our investees, supporting additional to understand their needs. And we conducted additional liquidity, solvency stress testing. The objective was to understand the need of our client to adequately respond to that. One challenge that we encountered at that moment was also finding a proper balance between providing sufficient information to our investors and avoid overwhelming our clients with unnecessary data requests. Working in over 50 countries was a challenge to be able to report to all our investors on the situation and evolution and potential impact of our portfolio. So we had to push back and strike that balance, providing sufficient oxygen to our client, but at the same time building trust with our investor and various stakeholders. And also because contributing to sustainability of the microfinance sector is a key element of our social mission, we rapidly engage with our peers, 9 MIVs representing 15 billion of asset under management, to make sure that we could provide an adequate answer. One of these initiatives was to reduce the burden on the reporting side for intermediaries, and that's how we came up with a common reporting tool that is used on a voluntary basis and made available to all investors, so that at some point, if an investee or if other investor wish to streamline 10 reporting into one, because an institution does not need to report on 15 different cash flow forecasts or stress test models, so that we could streamline these reporting requirements. And the second one that has been really key over the last weeks and a key achievement for the industry is that together with these MIVs, we agreed on a coordinated approach towards refinancing and restructuring. This was crystallized in a memorandum of understanding that was published 2 weeks ago, and which form really a strong basis for coordination over the coming months. Pragmatism, transparency, tolerance are key principles. and these allow us to, this create a positive spirit of cooperation amongst the different MIVs investors, and allow us also to reduce the response time and reduce legal costs for the institution. So moving to the next slide, one of our priority was indeed also to identify the financial need of our client, focusing on providing the good support. Therefore, our focus was to provide short-term liquidity solution for institutions that anticipate protected economic lockdown. And it was very important, in line also with the MOU, to send strong signal to the market that we continue to invest. In that respect, we disbursed over March and April 50 million USD toward our client institution. And we do expect, as you can see, in April, we have paused investment at our initiative, or sometimes and very often at the initiative of our client, indeed, as VisionFund indicated, also some institutions pause disbursements. So they told us, let's not disburse your loan today. And so in that respect, we paused almost 30 million of investments over the month of April. And you can see that we are expecting to move forward with this transaction in May and June. So we are analyzing all these disbursements closer to the date to understand the impact of the COVID crisis. We see some different response across the world. Different institutions have a different experience with respect to economic crisis. For example, in Eastern Europe, Central Asia, that have been through recently economic crisis, anticipating liquidity shortage and raising rapidly funding. So we have identified some of our strong partners, and that we want to make sure that we can provide them the adequate liquidity. Focus has been also to maintain disbursement to key sectors such as agriculture activities, to make sure they have sufficient funding for the harvest season, and also providing adequate answer to refinancing restructuring requests. So we have received since the beginning of the crisis 18 restructuring requests. In total, we anticipate more to come. This represents approximately 50 million restructuring refinancing, and we do see the effect of the MOU that we have engaged with the other MIVs that allows to negotiate much faster. I'm running a bit behind time. We can move to the next slide. So challenges ahead are threefold. On the operational side, it's very early to predict the scope of the economic and social impact of the situation. We see indeed temporary suspension of activities very varying across our institution. From approximately 30–40% of our investees do experience temporary or total suspension of activities. Some of them have been resuming already, and some of them continuing disbursing, also with tightening underwriting standards, restricting some more high-risky sector. What we see is we expect some sector to show more resilience, such as agricultural sector, rural areas, and we do also see a lot of potential in the acceleration of digitalization. Although we have to highlight that our clients live in the real world and not in the digital world. So if their revenue are on hold, well, regardless of the digital channel, they will have a credit, the true risk will remain the credit risk. The economic crisis to come and the exacerbating side effects such as market volatility, falling oil price, and raising basic food price are still very difficult to assess in terms of impact on our institution. The severity of effect will really depend on how long the pandemic will last, how the national governments will respond, and the effect, the impact of this measure still has to demonstrate results. So we have basically 50% of the countries where we do operate a reported debt relief program. We see a relaxation of capital buffers, liquidity reserve requirements. Also 60% of the country where we operate reported SME, agri sector support or relaxation of provision measure. But it still have to, we will have to see whether that will be sufficient. On the refinancing risk, we do see today we are very much focusing on the first wave. We are trying to flatten the curve with the MOU to make sure that we are stabilizing the funding base of our institution through rapid, timely restructuring. But we do expect a second wave with institutions potentially facing solvency concern, as rightfully highlighted by Johanna. I think that's with institutions reporting shortage in income, clients reporting shortage in income and portfolio at risk increasing up to 15%, potentially 15%. These will have financial implication, and it will also erode the capital buffers. So that will be the next challenge after liquidity. Another challenge that we see is also instability in capital markets that has resulted in high volatility in the hedging market. Sometimes we cannot find hedging partner, or the cost of hedging short-term restructuring is too high. So this might result in either FX risk passed on to the client, or to the client MFI, or even worse, to the end borrower. Moving on to the next slide. Yeah, I'm already over. Maybe
it's okay. No, sorry, I think that's the last slide I have up.
That's the last slide you have? Oh, you missed.
I'm afraid so.
Oh, I have it. Otherwise, no. I can just conclude that this global pandemic call for international effort. It's critical to protect the poor's income generating possibilities, and in that respect, the microfinance sector is deemed to play a critical role in supporting MSMEs, which hopefully will show to be a key actor in this economic recovery, to show to be more agile. Government measures often are deemed less effective in reaching out the informal economy, whereas microfinance institutions have developed a strong network and ability to support these income-generating activities for the most vulnerable people. So it's critical, in joining my other peers on the webinar, to preserve the strong foundation that has been built over the last 30 years in financial inclusion. And we believe that the MOU that has been signed by these 9 MIVs is already providing a very strong basis to prevent unnecessary distress, flatten the curve, and really focus on institutions that deserve a more intensive approach.
Thank you very much, Noémie. We're now going to, last speaker is going to be Tim Ogden, our good friend, Managing Director of the Financial Access Initiative and author of the Weekly FaiV, to give a short response to what the speakers have said and what he sees as the critical factors determining success or failure ahead. Tim, are you okay to share your screen? I can't add those notes you took to this. Is that okay?
Yes, give me just a second to figure that out.
We've got lots of good questions coming in as well in the Q&A bar. So yeah, after this, we'll be able to...
you need to stop sharing before I can start sharing, Sam.
Yep.
Okay. Thank you, everyone. Thank you for sticking around this long. I quickly wanted to provide a little bit of historical context, not to sort of dwell in this, but I think it is important as we think about what happens next, is to recognize that we are in a unique current situation, but not one without any precedent. So the modern microfinance movement likes to congratulate itself often on its innovations, but it is in fact part of a very, very long historical record of attempts to provide and extend financial services to the excluded. Those communities are excluded because poor customers are riskier and are more expensive. And the way institutions have found to deal with those higher costs and higher risks is to make some business model compromise. And those business model compromises eventually come due through some crisis or other. So just to give you an example, the trade-off, one of the trade-offs that we are now seeing come due is to keep the costs of providing many of the financial services that make up microfinance to poor borrowers in developing countries. We've adopted a light regulatory touch. And the reason for that is not because, in general, I think people don't think that regulation matters, but complying with regulation is expensive. And these are low margin products. And the idea was that these institutions, because they were pro-poor motivation, because they were primarily lending, could get away with a lighter touch of regulation. Now, as we enter this crisis, we see that a lot of these institutions are turning to regulators who understandably are looking at them with a bit of skepticism to say, you convinced us that you didn't need lots of regulation and supervision, so why are you coming to us for help now? That has been a historical pattern that has happened over and over again, and created situations where there were institutions that were created to serve these customers, eventually ran into trouble and failed, and sort of disappeared from the face of the earth, and then these institutions were reinvented at a future date. The modern microfinance movement does have a unique innovation in the history of finance, though, and that is the connection of local financial services to low-income and poor households with global capital markets. And that connection has been what has enabled the global microfinance movement to survive every prior crisis it's faced without actually much damage. So in every prior crisis of the modern microfinance movement, we've seen a disruption either of local cash flows, something like the Nopago movement in Nicaragua or the Andhra Pradesh crisis, or a disruption in global capital flows, like in 2008 or the Asian financial crisis. But in both cases, the industry as a whole was fine because the other side of the equation was still functioning. In the global pandemic, we're seeing disruption of both sides, of local cash flow and of global capital markets. And that's why I've repeatedly referred to this as an existential crisis. It's not something the industry has had to face before, and it is going to cause serious problems. But there is a question of what kind of crisis is this? I refer anyone who's not seen it to a blog post by Beth Ryan, who's joined us as a visiting fellow, sort of walking through this thinking, what kind of crisis is this global pandemic? And I think, while Beth focuses on the client side, it's also important to think about it from the institutional side. So on the client side, many of the things that we faced before have sort of been natural disasters. In a natural disaster, physical assets may be destroyed, but intangible assets are not. And that allows people to recover often fairly quickly with a bit of a cash injection. In a local depression, you can have a crisis where physical assets may not be destroyed, but lack of demand, lack of cash flow creates a big problem for businesses starting to generate funds again. One of the things we don't know about this crisis is the extent to which it's going to disrupt tangible and intangible assets. How could it disrupt tangible assets? People may have to start selling assets in order to feed themselves. We just don't know the extent to which that's going to happen. How can it disrupt intangible assets? We don't know the mortality issues. We know that many, many people have left cities around the world to go back to rural areas. We know that remittance flows have been disrupted in many areas. We don't know what effect that's going to have on supply chains, on customer relationships for small businesses. Are people going to be able to open in the same place? Are they going to have new competitors? Are they going to have fewer competitors? Are their supplier relationships going to be disrupted? Are they going to be able to get raw materials? For institutions, and here I refer people to some work that Dan Roses from e-MFP has done, looking at the liquidity and solvency sides of this crisis. As many of our speakers today have said, there's immediately a liquidity question for many MFIs where repayments stop. And because most MFIs are sort of close to self-sustaining, when your income stops, you're just like any of these other businesses, and you've got to figure out what are your reserves to cover your costs, and how can you restructure those costs to make those reserves last as long as possible. The longer this goes on, of course, we have a question emerging of solvency. And the challenge in the financial system is when a financial institution has to cut back operationally to preserve its capital, that also means that it doesn't have the cash to lend in order to generate new income. And you get the potential for a death spiral that can be slow or it can be fast. But those are the things that we have to watch. We have to watch to see region by region, institution by institution, what kind of crisis is this? And understand how it's affecting and therefore what behaviors are needed from the MFIs and from investors in order to both survive and recover. So what's next? As I said, we need to be paying attention to the signs of the type of crisis. One of the things I think we need to spend a lot of time thinking about is, therefore, once we've identified what kind of crisis is, what was responsible lending look like? And this question is both for the MFIs and for the investors. So for the MFIs, the history of the microfinance movement is essentially trusting in the availability of services, the dynamic incentives for repayment, the social networks, the weekly reminders, the structure to generate repayment. It's quite possible that those are enough protections of understanding who wants to borrow. I think we're already seeing, as a number of speakers have noted, that the demand for borrowing is down in many places. And we need to take that into account in understanding the crisis. But if demand restarts, how do we tell how much lending is responsible? What's going to help the customer? And if the MFI doesn't understand what kind of crisis its customers are facing, that it can't make responsible loans to customers. On the investor side, the investors need to understand MFI by MFI, how capable they are of making good decisions for their customers rather than good decisions for themselves, and understanding what kind of financing is going to be useful, what kind of responsible lending to the MFI is going to generate responsible behavior by the MFI. I would say, in general, as an industry, we've been able to take a lot of shortcuts here. And trust that, with a few basic rules of thumb, you could tell what kind of institution was, you could tell whether they were a responsible lender, you could tell whether this was going to, whether this institution was worthy of investing in. We're going to have to invest a heck of a lot more, both from the MFI side to understand our clients and from investors to understand the MFIs, to understand what responsible lending look like and who should, how we should move forward. I know this came up in the Q&A, and a couple of other speakers have mentioned it, is I'm very wary of the push to digitization right now for a couple of reasons. One is the people who have not already digitized tend to be the people who need more help digitizing, and we are not in a great position to provide the help and support necessary to them. So pushing people into a system that they don't trust, they don't understand, they don't fully comprehend, creates a lot of risks for those people. Referencing fraud. Whenever you get people adopting a new technology that they don't understand, you get a whole lot of people showing up to quote unquote help. And it's very hard, if you're not experienced with those technologies, to distinguish between what real help is, who legitimate actors are, and who are not. But beyond that, even the risk to the individual clients, we have to be honest. Maintaining digital security for an institution is incredibly expensive and essentially impossible to do perfectly. If you pay any attention at all to the news, you will see at least once a week a major global financial institution announcing some digital security risk failure that they've encountered. Customer accounts being stolen, even money being taken from an account on an unauthorized basis. Even the biggest and best can't do this perfectly. MFIs around the world are in no position to secure their digital presence. The human capital, even if they had the money to hire the human capital necessary to protect themselves digitally, that talent is just not there. If you think about many of the countries that MFIs serve and just count the number of highly qualified digital cybersecurity specialists, there just aren't enough of them to go around. And so we have to expect that as digitization happens, bad actors are going to realize that MFIs are a weak point in the chain, and there are going to be increased attempts to infiltrate MFIs and exploit them digitally. additionally, I worry that as we make this push to digitization, the people that we don't reach become more and more expensive to serve. And it's harder and harder to serve them. And you get this process where because of the cost of digitization, MFIs are put in a squeeze. They're losing their best, most digital customers to fintechs who have more experience, have access to more capital and better talent to be able to capture those customers. And so they're losing highly profitable customers at the top end. And they're still attempting to serve two client bases, one that's digital and one that's not. And that raises costs for the MFIs. And then the MFIs are put in this incredible squeeze where their profitability is suffering. They're already suffering through the pandemic and the costs of that. And now they're having to run two infrastructures as well as invest in the security of both. I think that is something we need to be paying a lot of attention to and be worried about on digitization. And then finally, I'll close by saying I'm not seeing personally enough discussion yet of what the right mechanisms for recapitalization are for MFIs so that they are in a place to be able to lend and do responsible lending post-crisis as recovery emerges. And of course, that's going to involve some difficult decisions of who to recapitalize. I do believe we are going to see a number of institutions have to close their doors. I think investors can play a big role in encouraging mergers or acquisitions, consolidation in the sector, so that key institutions survive and we don't pull back from offering services from too many people. And I think investors already need to be looking at each of their investees in each of the countries they operate in and thinking about consolidation in those countries. And with that, I'll wrap it up and turn it over to our Q&A.
Thanks very much, Tim, for that. Just share my own screen again. We've got a bunch of good questions in. I'm also pleased to see, thank you, that several the speakers have been actually addressing several of them in the Q&A. I noticed that Noémie answered the one about the scope of the MOU and its publication. You'll find a lot of more materials about that on the COVID inclusion site, the e-MFP, SPTF, CFI site, on the MOU, the pledge, the press materials, and really how they've come to be and what the roadmap is forward. Let's start with the question from Simona to Babak. And Babak, if you could be as concise as you can on this. Can you elaborate how COVID increases the risks of AML CTF? That's combating the financing of terrorism for everyone else. Could you address that?
I'll be happy to do that. First of all, I want to say that I agree with the last speaker, I believe it was Tim, about the risks. And the Financial Action Task Force, which is the major coordinating body for anti-money laundering, has issued some warnings and things that I welcome you to go and check their website because the discussion is pretty complicated. But to simplify to the extent that I can, is during this period, there's a lot of, a couple of things are happening. First of all, we're all shocked. We're all working on our business continuity, activated our business continuity plans. I mean, the supervisors, regulators, even the banks and financial institutions. A lot of people are working remotely from home. So what does that do? That decreases the opportunity to be able to scrutinize in an optimum way illicit activities, and also increases the reliance on digital technology. So, I mean, this is a witch's brew that is pretty toxic, if you can appreciate that. And we're also seeing a lot of hacking, illicit activities. WHO is being hacked, or people are claiming to be WHO and requesting all kinds of information from people. And this is a pretty difficult situation, and more and more attention is being paid to it. So that's how I would characterize it. There's an opening opening now structurally that has to be filled very quickly, but has created some gaps, which has made it open for AML and other activities potentially to take place. So in a sense, supervisors, regulators, and international bodies are predicting a lot of things that may not have happened, but also are looking at how issues are affecting. And just to finalize it, I also mentioned in my opening that many of the critical supervisory functions have been sort of, I wouldn't call it relaxed, but have been postponed or deferred. So this is also creating another vacuum in this space. Thank you.
Thank you very much. Got a whole bunch to choose from here. Noémie responded to one about the MOU, and then it says there appears to be an answer, i.e. restructuring client loans and the restructuring of the MIB's balance sheets, but who pays the cost of this? Noémie, that's got to be for you. Who pays for this restructuring? I think you're muted.
Thanks for telling me. You can hear me now?
Yes, thanks.
Can you reformulate, what do you mean that who pays for the restructuring?
It's from an anonymous attendee, so no, I can't, but restructuring client loans and...
So, I know if I will answer the question in the expected way, but typically what we try to look at is refinancing and stabilizing the funding base. So when we see institutions coming to us and telling us, look, we have some issue because we cannot collect enough and we cannot repay your loans and we need to reach out some, critical mass in refinancing. So we sit with the other lenders and we watch at this and the different repayment, and we all agree handshake agreements that we will all roll over for 6, 9, 12 months, sometimes more, of the repayments of the MFI. So it's not per se that we are mimicking, and I know there were some thoughts about a blanket moratorium from lenders towards MFI. We don't believe in that. On the contrary, I don't see why I should provide a moratorium of 3 months on an institution that is having, that does not need it. And on the contrary, that will need fresh funding. And so having such agreement will be more detrimental to them. And so the advantages of the MOU is that we do not have to enter into long restructuring agreement with the MFI. We just have a few emails and shake with the lenders. We organize some lenders call. We agree on the approach, and we all bilaterally roll over or restructure the loan by the period that has been agreed by the lenders. And so we do prevent the lengthy and costly workout process involving legal. The only thing that indeed might and then have provoke additional costs is the hedging, as I highlighted. So sometimes you would like to extend the loan, but increasing hedging costs must be passed on sometimes to the institution, because we are not allowed as a policy of the funds to provide hedge facilities. Converting the loan in hard currencies too risky for the institution. So sometimes we have to, the institution has to pay for higher hedging costs. I don't know if that answered the question.
Thank you, yes. We've got several more here. Chris asked for some less heartwarming examples than perhaps Centenary and ASKI. Can we have some frank examples of the more challenging and less than positive responses? I think, Johanna, you probably have a good umbrella view. And I don't know how able you are to talk in specifics about that, but can you talk in generalities of who's getting it wrong?
I can probably talk in generalities. When I read this question, there were several responses that came into my head. The first is that when the crisis hits, we all behave in an irrational way, is my first notice, is that everybody tries to do everything all at once, rather than sitting still and thinking through what needs to be done. And I have to say that in my experience, the first few weeks of the crisis, depending when the crisis hit, was a bit like all of us running around like headless chickens, as we say in this country. And then things kind of calmed down. But in the meantime, we lost some time. We perhaps lost some opportunities. The other thing that I would say is that pre-existing bureaucracies tend to continue behaving as they always do, i.e. they continue to be bureaucratic. And in a crisis, one needs to adopt different behaviors. And so I would say, for example, while I completely agree with everything Tim says about the risks associated with digital, in a crisis, one has the choice between going through a very precise and lengthy and risk-averse, completely risk-averse way of putting a digital solution in place, or you go, you know what, let's do this, make sure that the client doesn't suffer, that we underwrite the risk, and let's just figure out a way to get the payments in during this time of crisis. And it's not for the long term, it's just for now. We think it's 80% right, let's do it. And that's really difficult to change your behavior to respond in that way. And then I can probably hear what Tim's thinking, yeah, but then how do you undo it? Well, then you go and you plug in your gaps. You have to plug in your gaps because we are all socially motivated, we are all impact motivated, and therefore the client has to be at the center of all that we do. So I guess I would say that I've seen quite a few examples of bureaucracies finding it difficult not to behave like bureaucracies. I know that's very general, but without going into specifics, that's how I'd leave it.
Johanna, while I have you talking, I have a question to put to you and to Rolando as well. You said that you're talking about recovery lending and the experience of Typhoon Haiyan, and that's something that obviously ASKI in the Philippines has had a lot of experience with, and they've got their partnership with Oiko Credit on that. But you said the demand is down for credit right now. Mm. That's counterintuitive, isn't it? Surely, right. And the need for recapitalization, as Tim mentioned, surely demand is the highest it would ever be.
Demand, okay, you're right. But it's what kind of demand it is. So we have to be careful always to do no harm in our lending. So we're not going to, for example, if a client is already behind in their payments before this crisis hit, that suggests that they actually don't have the capacity to take on any more credit at all. However, if you've got a client that is only affected by the indirect effects of COVID-19, then extending to that credit to that business to see them through the difficulty and provide recovery lending when we're getting over that mountain of the crisis, then that's a completely different scenario. So it is fundamentally about doing no harm in the first place to the client. And if you're doing no harm to the client, then it's probably good lending practice, because we don't want to be losing any more money either.
Rolando, how do you balance that need to do no harm with the clear need after lockdown for clients that are delinquent, they're behind on payments because of what's happened, yet what they really need is recapitalization of their businesses? How do you balance that with not hurting them?
Actually, what we did is immediately we convene the disaster risk management team of ASKI and do a lot of assessment per area, what kind of business we have to support. That's which is our priority. We actually provide a lot of support for those small farmers because it's linked with the food security issue. And also we tried to negotiate with the government what kind of support we can work with. And also, since some of our clients that are already, they have their matured loans, they have the required savings with us, and also what we call the capital build-up. We're trying to evaluate their business, and this is now, as I have mentioned, new norm, identifying what kind of business is the priority at this point in time, and how we can work with the government and other private sector, because based on the experience, every time that there is a disaster, it helps if you have a strong partnership with local government units and other private sector in supporting our clients and even non-clients. So because based on our assessment, our clients and even non-clients, they need also some social support. So that's where the other private sector and government agencies that we partnered with, they provided a lot of support on that case. So we're supporting on the livelihood side. So that's how we work. Thank you.
Thanks. We have, there are several more questions and which we don't have time for, but I encourage you to have a look at the ones if you haven't already in the Q&A, some of which the speakers have kindly dealt with. I have plenty more of my own, which we don't have time for at this point, so we'll have to wrap things up. I'd like to thank all the 6 speakers for taking the time to prepare for and take part in this and sharing their insights and experiences. Thanks to colleagues at e-MFP and FIF UK, as well as the Luxembourg Ministry of Foreign and European Affairs and City, CDC and EY as respective supporters. For those of you who are interested, please sign up to the FIF UK mailing list or e-MFPs as well, and consider supporting or becoming a member of either organization if it's something your organization can do. This is more important than ever, these collaborative networks. One quick plug to something, the Financial Inclusion Compass, which is e-MFP's annual survey of sector trends, is being moved forward this year and will be specifically COVID focused. It's going to be entirely on COVID responses, challenges, solutions, and forecasts. I encourage you to look out for it and to take part, please. It'll be the first genuinely sector-wide look at whether we're going in the right direction on all of this. I'd like to thank you all for attending today. The recording of this webinar will be made available on the e-MFP and FIF sites. Please send us feedback too, including if you're interested in this being a more regular series every month to 2 months on a check-in on this. That's something we can consider if there's interest in it. In the meantime, stay well, take care, and thank you. Bye.
Thank you very much.
Thank you very much, everyone. Bye-bye.
Thanks. Bye.
Thank you. Bye.